Dan, Dan has laid out the thesis of it in his earlier comments. It's really the potential loss of Iranian supplies and Iranian exports. Iran is one of the top 15 of global crude exporters, and so the loss of 1.5 million barrels a day is something that the market is potentially pricing in. But it's not necessarily the worst case, because the worst case could well be if Israel strikes Iran, Iran takes actions to slow down or potentially try and block the Straits of Hormuz, which would have a far more dramatic effect, because that is where 20% of global crude exports travel through from the likes of Saudi Arabia, Kuwait, and Iraq, and the UAE to some extent, that are the holders of the global spare capacity. So we contend the market is not pricing in the worst case; it's pricing in the potential impact on Iranian energy infrastructure.
Alan, anyone who follows oil markets know there's a lot of politics in the mix here. And what you spell out would be a horror scenario heading to a US election. So how much heat is being applied through back channels at this stage?
We would expect quite a lot, because that is very much a worst case scenario, and something that we hope not to see. In fact, we hope not to see the Israelis attack Iranian oil infrastructure, because it's very hard to avoid escalation at that point. But we suspect there is an awful lot of chatter in the back channels to try and move away from that.
Alan, lovely to hear your thoughts. There's a lot going on in the oil markets at the moment, but one thing that both Energy Aspects and indeed another contributor on this show was saying in the last couple of days is there is a historically large short out on the market as well, which may have exacerbated the move to the upside on both Brent and WTI in the last 7 days. If there is no geopolitical exacerbation of tensions and we don't see the Iranian facilities hit, is the price going back down again aggressively, or are there other factors which could be supporting the market?
We'd expect prices to be, in a sense, broadly stable, but with downward pressure, because what we're seeing, in a sense, the market has plenty of supply. OPEC is restricting volumes. We think they need to continue to do that through Q1 next year. So the early release of those volumes would put downside pressure on the oil market. There's just plenty of supply. Demand growth isn't particularly strong. We see the US, there should be growing confidence the US is not going into a recession next year. And the China stimulus has very much helped the stock market, but not necessarily the physical supplies quite yet. So we see downside risk to oil price if geopolitical tensions ease quickly. But it's hard to see that the conflict in the Middle East resolving itself entirely quickly.
In terms of the oil producers, I guess Shell isn't going to be an outlier in its statement today, saying refining profit margins dropped sharply in the third quarter from the previous 3 months as demand is sagging as well. Just looking at that demand equation, as I was chatting with Amrita Sen, we're saying, well, normally the cure for high prices is high prices. The cure for low prices is low prices. But we're not seeing particularly an increase in demand at these lower prices. Or are we, Alan?
We've got demand growth at about 1.4 million barrels a day this year. We're looking forwards to a stronger global GDP impact outlook for next year, giving a similar, if not slightly stronger growth outlook. Historically, that's actually quite a positive number if you look at sort of a long-term trend and ignore the COVID and the COVID recovery years. But the challenge is that demand growth is being matched by the growth in non-OPEC supply, which leaves OPEC with the dilemma as to how it returns its volume. So it's not necessarily a demand scenario. It's the fact that actually demand growth and non-OPEC supply growth are very, very similar, which with OPEC having cut production, that really presents it with a dilemma as to how it returns those volumes. And the fear it has of concerns always come about when it's cutting production around losing market share.